Francois Savary, good morning. How are you this morning?
Good morning. I'm fine, and you?
Very good, thank you. Let's dive straight in. It's quite a busy week this week in terms of numbers. I'll just go through a list of the ones that I thought were quite important. So there's a 10-year auction in the US, US CPI, US PPI, there's a US 30-year auction, inventories, Fed interest rates decision, obviously, FOMC conference, Swiss National Bank interest rates decision, Bank of England, and the ECB. US retail sales, which are expected down minus 0.1% after a record Black Friday, and ECB press conference. Which are the ones you're most looking forward to amongst those numbers?
I would say that the most important one are the CPI and the PPI in the US. They will be very, very important to see if there is a continuation of the trend to lower inflation that materialized over the course of the last few months. Obviously, I'm going to look very carefully at the central banks and the conference of the Fed. Mr. Powell is going to come out with the dot, those famous numbers concerning interest rates and main economic numbers by the member of the Fed. They are very, very important. And if I may add a few statistics that you did not mention, I think that you need to take a very careful look at what the PMI numbers in Europe for December are going to reveal in December. People are expecting that there is some kind of small recovery in the numbers. It's very important to see if there is a kind of bottoming in economic activity in Europe. And also, after the very poor numbers that we had in terms of CPI in China, I think that people need to take a look at what is happening in terms of industrial production, retail sales, and those numbers will be published by the end of the week.
Coming just quickly to US retail sales, it struck me that the expectations are for a slight drop in retail sales, which is very surprising. Does the retail sales, does that include online sales as well, first of all?
Online sales are included in retail sales. Never forget that the numbers that you mentioned is a number concerning the year-on-year annual growth, the year-on-year growth of retail sales. So it's a comparison with what happened at the end of last year. So the minus numbers can reflect, first of all, the fact that retail sales were quite strong a year ago. And second, what you need, and we all know that, the main driver of economic activity in the US lately has been the consumer. And there are some signs that the consumer is retrenching a little bit. So maybe that's explain why this number is expected to be negative when it is published.
There's an interesting article this morning in the Financial Times. It says that the central bankers are really going to try and dampen expectations of the markets about next year's interest rate cuts. Are you expecting them to make any different statements to the ones they've already made, or are they just going to continue hammering home higher for longer?
To my point of view, they are in a very difficult situation because of the rally on the market and the fact that, as you mentioned, market expectation have turned out to be very, very significant in terms of change of course in monetary policy, both in Europe and in the US. I think that they have a very limited path. It's going to be difficult for them to change course and modify the idea that the interest rates are going to stay high. They will not go for a discussion about the interest rates are going to come down. It would be too early, and it's not something that they want to do. So yes, in a way, they have a difficult path to find, which is mainly the message: we are not going to lower interest rates. They are not going to mention that. We want to keep interest rates where they are, waiting for confirmation that the economic slowdown is coming and that we have a full control on inflation development in the medium term. So in a way, in a nutshell, you could say, yes, it's higher for longer should be the main message that they are going to provide us.
Do you think the market's going to be very disappointed this week? The market has maybe got ahead of itself in the last month or so. How do you think the market's going to react to the consistent message coming from the Fed and the other central bankers?
Again, it depends of how they are going to, which words they are going to use in this message for higher for longer. And people are going to check if there is a change of wording, if he's going to retract. For example, if Mr. Powell is going to retract from the idea that the monetary policy is already in a very or significant restrictive territory. So it's going to be in the wording. Does it mean that the market are going to come down? Obviously, what you saw at the end of last week is that the bond market came under pressure. And, you know, we were on the 10-year bonds, we were at 4.10. Today, we're at 4.25. It means that the bond market is already reacting, and quite significantly, to the fact that the numbers that we had over by the end of last week were not confirming that there was a significant slowdown in the US economic activity. So at the end of the day, you cannot say markets are not going to react. Depends on the words they are going to say. If they are just saying, and if they are just reaffirming the message that they had, I think the market can cope with it. If they are adding some kind of, I would say, restrictive bias, then the market can be quite volatile in the coming days.
You've been contrarian compared to your peers in terms of expectations for next year's interest rate drops. It seems as though the market is coming more towards you, and they've pushed back the expectations for in terms of time for the interest rates next year. Do you think they need to push back a little bit more?
I think so. I think that I always have had a lot of trouble concerning the fact that there could be some lower interest rates by the end of Q1 or early Q2. I still believe that with the numbers that we had at the end of last week in the US, the non-farm payroll, the fact that the unemployment rate came down, I think that all those numbers are telling you, and more, we need to add that the fact that the average early earnings went up. And, you know, the monthly number for the average early earnings in November was 0.4% on a monthly basis, which is the highest number for 2023. So it tells you that in terms of mastering inflation, you are not necessarily there yet. So I think, yes, they are still too hopeful in terms of when the Fed is going to cut. And I still believe that the market needs to get back to the idea that it's more going to be May or June that you're going to see the first move by the Fed.
Coming to Asia, the one bright spot in Asia is Japan in terms of the indexes. The market seems to be happy that the Bank of Japan won't be raising interest rates this week. It seems as though the Japanese are in a bit of a fix. How are they going to get out of this?
Very, very good question. Again, you know, last week for the Bank of Japan, there was a good number. It's the fact that the GDP number were revised downwards. So it told them, in a way, that they don't need to hurry to change course of monetary policy. I still believe that they are going to change course of monetary policy by the first quarter of next year. One of the reasons being that inflation seems to be entrenched in the Japanese economy to a level that is satisfactory for the Bank of Japan. Moreover, we had a number last week that was interesting. It's also the fact that the real wages are increasing at a faster speed than was expected. So I think that you have some numbers pointing to the fact that they need to change course in monetary policy, but they can be gradual in the way they are going to do it. And in this regard, there are some very important numbers that are going to be published in Japan. I think it will be by Wednesday. You will have the full detail of the Tankan survey, and it's going to tell us a lot about how healthy the Japanese economy is. They need at one point to change course. I think it's necessary for the Japanese economy the Japanese central bank to change course, and I think it's going to happen by the end of the first quarter of next year.
You were bullish on the yen, if that's the right word, when it was at 152 about 3 weeks ago. The yen got to 140, 141 against the dollar, and it's retraced since then, especially this morning, back to 146. Your call for the yen dollar was dollar yen, was 135. Have you changed your expectations? Because the moves happened pretty quick. Huh?
No, I have not changed. You know, very short-term move on the Forex are quite usual. The one that we experience on the yen dollar was quite significant in terms of, as you mentioned, going from more than 150 and in the mid of 140. I think that it's logical that there is some retracement. I don't change my view. And again, I think that that's a key element. The yen cannot appreciate too quickly, too much. So it's very important in the course of the next few months, we will not get to 130, 120. And I don't think it's going to be the case because it could be very dangerous for the Japanese economy. So that's the reason why I stick with the idea that down the road, the yen is going to go down to 135. It's a limited appreciation from the current level, but I think this is something that the Japanese economy can support.
In terms of real estate in the US, let's go to the US now. In terms of real estate, the wage growth is quite impressive. Obviously, employment continues to go down. That is quite supportive of the stock market, obviously. But if you look at the S&P 500, five stocks are 25% of the weighting of the index. It hasn't exactly been a broad-based rally this year. What is the good news? What is going to push the stock markets up next year, in your opinion?
Okay, but first of all, yes, it's not the first time in the history of the American equity indices that you have a few stocks making a lot of the indices. We had that over time. Usually it has never been a very good sign. Usually it is a sign that you need to be a little bit cautious. But you are right. This year, the rally has been mainly driven by 5 or 7 stocks. We all know the story of the artificial intelligence that drove these super stocks going up while the market was nearly flat or a little bit high. What can drive the market higher? I think you have 2 elements that are key. The first one is interest rates. Are we going to see interest rates come down in 2024? We all know that the market participants now are expecting a lot on that side. So if you don't have these interest rates fall in terms of going to 4%, and then some big banks are expecting 3.5% on the 10-year, then you have a trouble. And the second element is again the same. It's the EPS, it's the earning per share. You know, at the end of the day, the market is driven by 2 factors, interest rates and the ability of stocks to deliver on the growth side. So those are the 2 elements that we discussed over the last few weeks that are going to drive the market. We discussed also the targets that the main central bank, the main investment bank have. You have some banks that believe that it can go to 5,400. You need to have a lot of support of interest rates and earning to justify such level on the index, on the S&P 500 at the end of next year. So that's the reason why you need to be moderate in your expectation for the market in 2024. The market is not cheap, and you have uncertainties concerning earnings.
There's been big inflows into stocks in the last 6 weeks or so, from both retail and institutionals. Has the market got ahead of itself? Did it peak too soon? Do you think this week will signal the end of the market's hopes for a Christmas rally, for instance?
But you know, again, when you look at the market, I know that the S&P 500 got a 6th consecutive week of progression last week, but it was quite limited, you know, and it was mainly driven by the market reaction on Friday. So I think you can see the sign that the market is cooling. It's cooling down a little bit. And that already, and as I mentioned, the bond market is under pressure. So the environment last week changed compared with the one we experienced in the 5 preceding weeks. You already have signs that the market is cooling down. Yes, I agree with you. I think that the market is a bit ahead of itself. And the interest rates developments are telling you that suddenly people realize that it's not going to be that easy for the Fed to lower by 125 basis points next year. So I think, yes, now comes the time for people to reflect and to think the Fed in these regards and other central bank decision this week is going to be very important in determining for the market participant to determine what is the next step on the equity market.
Francois Savary, thank you very much indeed. That's all we've got time for this morning. Speak to you next Monday. Bye-bye.
Bye bye.